I had a client who had vested stock at $100 a share, rode it all the way down to $10 a share, and then systematically liquidated over time. Watch on for a story of true risk tolerance, and definitely watch to the end for a few misconceptions I see about risk tolerance as a practicing advisor. Hey everyone, I'm Andrew. I'm a CFA charterholder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do is I take the learnings from those thousands of iterations and I give them to you so that you can apply them to your own situation. Today, I want to tell an illustrative story about risk tolerance because I see it misused so much of the time. And it makes me think of this client I had who invested stock in a public company at $100 a share. And the problem is, whenever you vest public company stock, they don't want you to sell it. And you can't do things like short the company, right? That would be bad for business if insiders were doing that. And you're left with very few options. By the time they were able to sell the stock, it was roughly $30 a share. Okay, so about a 70% loss. The first thing that we did is what I call the bankruptcy test. We said, can the retirement plan still be successful with and without the stock? With the stock at a 70% loss, the retirement plan was still okay, but if it did go to zero, their probability of success of making it all the way out to 95 without becoming destitute, it was lower. It was in the high 50s, low 60s on a percentage basis. And so what that did is it then forced us to have a different conversation about, let's revisit your estate plan and your legacy goals. Let's revisit your philanthropy goals as well. And are you okay with there maybe not being anything left at the end? And what the answer was is, yes, we don't really have defined goals in either of those areas yet. And we are willing to retain the risk of this stock going to zero for the possibility of it coming back. Notice that we started with the retirement plan. The reason you have to start with that is, as humans, we have these biases, right? And they fall into a couple of different buckets. You have your cognitive biases and you have your emotional biases, okay? And a cognitive bias is something like confirmation bias, where this person could have said, you know what, I work at a good company, I work with really smart people, they care about the company, they care about the stakeholder, I think we should really hold the stock. You're attributing stock performance to your anecdotal evidence, which is to the positive. What you want to do to mitigate that is run an independent analysis that's detached from your anecdotal evidence and gives a more robust statistical evidence. And that's what we did. And what we really found was it's a good company, but a bad stock. You see this all the time with companies. Cognitive biases can be fixed with information and education. Emotional biases, because we all have emotions, right, are more difficult. And something that I see frequently is loss aversion, which is a multi-pronged attack. Loss aversion exists because as humans, we feel the pain of a loss about, I think it's 3 to 4 times more than it feels good to have a gain. And so that mismatch in feelings creates things like you tend to hold on to losers far too long because you think, oh, it might come back. It might come back. And it's not coming back. In addition, and I see this with options traders all the time, you have a loss and then you increase the risk of your portfolio to try and gain the money back in other areas, even if you've accepted that that loss is going to occur. And so emotional biases really have to be worked around at the end of the day, because we all have personalities and we all have our tendencies, and we can do as much as we can to mitigate them, but many times it's easier to invest around those biases. So after we reran the plan and realized, you know what, if we make some concessions on the estate plan and on the philanthropy goals, we can still accept this stock risk with the full understanding that it may actually go to zero. And we've illustrated it going to zero. However, we wrote it all the way down to $10 a share, which is a 90% loss. And then after years, not days, not months, after years, it came back slowly to $40 a share. And at that point, we started to systematically liquidate. Think of it as reverse dollar cost averaging. So many shares per month until when it got to $60 a share, we ended up liquidating the vast majority of the stock. A few takeaways that I want you to have from this story. Most people do not have this type of risk tolerance. I see it infrequently. Most people do not have true risk tolerance like that because it's hard for all of us, myself included, to keep our biases at the door and be unemotional and detached from our investing. And that's what this person was able to do. Furthermore, they viewed it in their mind. They flipped the narrative in their mind when it was $10 a share to say, I essentially have a long-term call option on this company. If it goes well, the returns from here on, because the rest is a sunk cost, the returns from here on will be exponential or it will be worthless. And by doing that, they were able to mentally account for it in their mind, which is another bias, but in this context, it actually helped them. So most people don't have this risk tolerance, but they can be fooled into it because us as financial advisors, we have you take a risk tolerance questionnaire. And what I'm here to tell you is I find them to be mostly useless. There are some things you can glean from them, but you are asking in a non-emotive state in your living room at 7:30 p.m., how would you feel in your most anxiety-ridden state? And when I say it like that, it doesn't really make sense now, does it? We take those answers and then we create a portfolio based on those answers rather than relying on your risk need, which is how much risk do I have to take for the plan to work, and your risk capacity, which is how much risk can I take given the plan. They're opposites. Notice that every decision we made was informed by the financial plan, and then we adjusted the investment output, not the opposite. Risk tolerance puts the cart before the horse. If you truly want to see your risk tolerance, the next time there's a bear market, write yourself a note of how you felt during that bear market and what you would like yourself to take away from the next bull market whenever things feel good and it seems like everything's going up. Finally, I'll leave you with this. Risk tolerance is not static. It's dynamic over time based on your period of life. Think of if you were having to take $250,000 out of your portfolio every year and the market goes down and your net worth is now 25% lower. Can you handle that? Being an income distribution in your risk tolerance is completely different than being in accumulation in your risk tolerance. Because with one of those, you can set it and forget it, right? It's even tough based on how you experienced, for example, the 2008 financial crisis or COVID when you were working, to extrapolate that data and those decisions and those feelings to how you will feel whenever it is income distribution time. What I have found to be a good mitigator to that is to become overly cautious up front. And if you start to feel yourself frustrated from the lack of risk you're taking in your portfolio, to systematically increase it over time rather than the inverse, which is to have too much risk and realize I was not actually that risk tolerant. I hope this story gives a good illustration of the difference between risk tolerance, risk capacity, risk need, and how you should view that going into retirement and just in general as a framework. So until next time, hope it's helpful. See y'all.